We also welcome all ICGN members, OECD Corporate Governance Committee delegates, delegates to the OECD Working Party on Sustainable Finance, and all the numerous participants at the meeting. So thank you for being here. I hope we will spend an interesting, hour addressing all very, very important topic, which is quite relevant in corporate governance, but also, so indirectly access to finance, all the debates, and also supply and demand of capital markets. So it's now my pleasure to invite Toshiyuki Mihoshi, Vice Chair of the OECD Corporate Governance Committee and Vice Minister for International Affairs at the Financial Services Agency of Japan, to present an overview of the report. So Toshi, the floor is now yours, and thank you for being here.
Thank you, Carmier. Welcome, and thank you everyone for joining this event that is joint OECD ICGN webinar to launch the OECD's new report, The Role of Capital Market Service Providers in Corporate Governance. It is a pleasure to give a kind of introductory presentation on this new report. In today's capital market service providers such as proxy advisors and index providers are playing an increasingly central role in investor decision-making and shaping corporate governance and supporting capital formation. So next slide, please. My presentation will cover three parts. First, I will present a brief introduction to the report we are launching today. Second, I will provide an overview of trends in regulatory frameworks for the key capital market service providers covered in this report, with a focus on their methodology, transparency, and conflicts of interest. Third, I will present the report's considerations. So let's go to the slide 4. So this report examines the regulatory frameworks and market practices for capital market service providers whose analysis and advice inform investor decisions, focusing on two core issues: methodology transparency and the management and disclosure of conflicts of interest, with the principle 3D of the G20 OECD Principles of Corporate Governance. Among a broad range of entities and professionals, this report focuses in particular on proxy advisors, ESG rating and data providers, and index providers. This report draws on responses to an OECD questionnaire from 50 jurisdictions and includes 3 detailed case study chapters on Belgium, reflecting the broader EU framework, on Chile, offering an emerging market perspectives, and on India, which has developed a detailed regulatory framework for the main capital service providers in scope of this report. So let's go to slide 6. Now let me turn to the first main capital market service provider covered in this report, which is proxy advisors. I'm sure we all acknowledge proxy advisors playing an influential role in shareholder voting. However, as panels A, B, and C demonstrate, oversight remains uneven. Panel A shows 60% of jurisdictions have legal or regulatory requirements, shown in dark blue. 10% rely on voluntary codes and principles, shown in light blue, and 30% have no requirements or recommendations, shown in yellow. The second bar in panel A shows that 62% of jurisdictions have a specific definition of proxy advisors. While scope varies, most definitions share common elements, indicating broad convergence. To support greater consistency, the report also proposes a reference definitions for policymakers and market participants. Panel B in the center of the slide examines the methodology-related provisions for proxy advisors. 2/3 of jurisdictions require or recommend proxy advisors to disclose the methodologies they apply when issuing voting research and recommendations, as seen in the dark blue and light blue shading. By contrast, the second column of panel B shows only 8% require or recommend proxy advisors to take account of national market and company-specific conditions. Panel C on the right-hand side of the slide focuses on conflicts of interest. 2/3 of jurisdictions require or recommend proxy advisors to disclose actual or potential conflicts, as seen in the dark blue and light blue shading. But more detailed conflict-related provisions are far less common. Only 8% require or recommend the disclosure of secondary services provided by proxy advisors, such as consulting to listed companies, while just 2% require disclosure of the ownership structures, as seen in the dark blue shading. Next slide, please. Let me now turn to ESG rating and data providers, another increasingly important part of the investment ecosystem. 2/3 of jurisdictions have frameworks for ESG rating providers, as seen in panel A on the left-hand side of the slide. However, most frameworks do not include ESG data providers, which creates a regulatory gap despite investors' reliance on raw ESG data, for example, on estimated greenhouse gas emissions. The first column in panel B in the center of the slide shows 62% of jurisdictions require or recommend ESG rating providers to disclose their methodologies, although 60% require or recommend methodologies to be updated or reviewed. Independent reviews are rare, with only one jurisdiction mandating them. As panel C on the right-hand side shows, 2/3 of jurisdictions require or recommend ESG rate providers to disclose conflicts of interest, and the same proportion are required or recommended to adopt policies to manage them. In addition, 52% require, as seen in dark blue shading, and one jurisdiction recommends, as seen in light blue shading, the disclosure of ownership structures. Next slide, please. Now let's turn to the last key capital market provider in scope of this report, which is index providers. Index providers present a somewhat different picture. Their regulatory frameworks are more developed than those for proxy advisors or ESG rating providers, but often apply only to benchmarks that are considered significant or systemically important. As panel A shows, 70% of jurisdictions have established legal or regulatory frameworks for index providers, frequently using the proportional approach. Panel B shows methodology transparency is central to index provider regulation. 70% of the jurisdictions require disclosure of methodologies, while 64% require consultation, explanations, and user notification for material changes, and the same proportion require periodic methodology reviews, often with independent assessment. Conflict-related requirements are also addressed in most jurisdictions. 2/3 require disclosure of actual or potential conflicts and policies to prevent commercial interest from undermining benchmark integrity, as seen as in the first two columns of panel C. By contrast, ownership transparency remains rare, with 96% of jurisdictions imposing no such requirements, as seen in the last column of panel C. So this brings me to the policy considerations for policymakers and regulators, which includes two cross-cutting issues relevant to all three capital market service providers covered in this report. First, conflicts of interest remain a key concern, particularly where firms both assess issuers and provide them with additional services. While some jurisdictions require separations between affiliated businesses, further oversight and greater transparency on revenues by business line may be needed to support compliance and assess the effectiveness of internal controls. Second, market concentrations warrants continued oversight and proportionate regulation. Proxy advisory and ESG rating markets are highly concentrated globally. which raises concerns about competition, accessibility, and accountability. Effective regulation can help support new entrants, improve transparency, and reduce over-reliance on a small number of global providers. Next slide, please. Now this slide examines the proxy advisor-specific policy considerations put forward by the report. As mentioned earlier, proxy advisor oversight remains uneven. Therefore, introducing minimum standards through regulation or recommendation and assigning clear responsibilities for their oversight could strengthen transparency, accountability, and market confidence. The second point notes that the competence, experience, ethics, and independence of proxy advisory staff remain largely unaddressed, with 90% of jurisdictions setting no standards in this area. Targeted disclosure-based measures such as transparency on staff qualifications, headcount, and use and oversight of temporary staff during proxy season could strengthen quality, objectivity, and accountability without imposing unnecessary burdens. Third, to encourage proxy advisors to better reflect national, market, and company-specific conditions, policymakers could require or recommend some measures. For example, sharing draft reports with companies for timely review, appending company responses to final reports, publishing updated benchmark policies well ahead of proxy season, and disclosing the rationale for recommendations that go beyond legal requirements. This brings us to the policy considerations for ESG rating and data providers. First, a lower share of jurisdictions addresses ESG data providers in their requirements or recommendations. Extending oversight or adopting recommendations already pursued in some jurisdictions could strengthen the quality, consistency, and reliability of ESG data. Second, opaque ESG rating methodologies and unpredictable update schedules can undermine comparability, trust, and investor confidence. Policymakers could therefore focus on improving transparency around methodologies and update timing, while avoiding interference in rating models themselves, so as not to stifle innovation and compromise independence. A third policy consideration is stronger engagement with issuers. Clearer requirements or recommendations for ESG rating providers to engage with issuers could improve correction mechanisms and allow factual inaccuracies to be challenged through let me share policy considerations related to index providers. First is the topic of proportionality. Currently, 70% of jurisdictions regulate index providers, and many already focus only on significant or systemic indices. This targeted approach alleviates compliance costs for providers of less significant indices and can support competition in a concentrated market. It can also help supervisors allocate resources more effectively and may be a useful model for jurisdictions considering broader index regulation. A second policy consideration is fairness and accessibility in index provision. High licensing fees in some markets may limit access, so policymakers may wish to monitor this more closely and consider measures such as equal and reasonably priced access to market data to help ensure a level playing field among index providers. Third, policymakers could consider standardizing minimum notice periods for significant methodology changes and index constituents decisions. Greater oversight may also be needed where index providers exercise discretion, particularly in ESG indices or during corporate events, to ensure clearer disclosure of underlying data and methodologies. So thank you very much for your attention. I encourage you to download and read this excellent report from the OECD. I will now hand over to Carmine, who will moderate the panel session. Thank you.
Thank you very much, Toshi. And I mean, complete. Obviously, the report is full of information and further data, and so really, we encourage you to download and read it. And now let's turn to our panel discussion. And I'm delighted to be joined by three distinguished panelists, each bringing a unique perspective to today's discussion. We begin with our co-host, Jen Sisson, CEO of the ICGN, International Corporate Governance Network, which represents investors managing over $100 trillion and promotes high standards of corporate governance and stewardship globally. Next, we have Neil Akres, the Managing Director and Global Head of Government and Regulatory Affairs at MSCI, an international provider, the international provider of indices, ESG ratings, and investment analytics for institutional investors. And then last but certainly not least, very happy and pleased to welcome J.N. Gupta, co-founder and managing director of Stakeholders Empowerment Services, CES, an India-based corporate governance research and advisory firm that also offers ESG ratings. So together, our panelists represent some of the key actors involved in the capital market service providers ecosystem. So investors as clients of these services, and of course, the providers themselves. So I will ask one round of questions directed at each panelist before opening then the floor for exchange among the panelists and questions also from viewers via the chat function. So viewers are encouraged to ask questions throughout the webinar via, again, the chat function. Now, let's start, Jan, with the growing importance with you, and thanks again for it's great to be together with ICGN and OECD. So the growing importance now of capital market service providers is closely linked to the rising role of institutional investors in capital markets, which, by the way, also we have documented the important OECD papers. Now, in your view, can greater regulatory attention and public scrutiny of service providers, particularly on proxy advisors, strengthen the ability of institutional investors to make well-informed investments and stewardship decisions? Please.
Well, thanks, Carmen, and thanks for asking us to participate today. And I'm glad to have, I think, lots of ICGN members listening. I mean, this is certainly a very interesting topic for us. And institutional investors, as you rightly say, are an increasing part of the public markets around the world. And I think we are in a world now where sort of sustainability related long-term broad governance factors will be much more integrated into investment processes as well as into specific pieces of that, like stewardship, like proxy voting, and various things. And so obviously this broad ecosystem of service providers does play an increasingly important role in how the capital markets work and in how institutional investors work. But I think we want to make sure that we're absolutely crystal clear, though, that they are service providers to investors and that they're not, in our view, fiduciaries in and of themselves. Our members as investors will use a whole wide range of service providers, and then we should think really of them as supporting tools to the investment process, but that, remember, the investor retains the judgment and responsibility. And so I guess my first thing is to say we mustn't lose sight that what is absolutely most critical is the appropriate disclosure and transparency from the underlying companies, right? Before it gets up to a data aggregator or before it goes through a research process, what is absolutely critical is there comparability, consistency, is there good governance around the reporting from the companies? And that, in our view, is absolutely the first priority. Right. And so I think, strong governance standards, Carmen, as we always talk about, that's the fundamental, right? Is like, what have we got happening at the actual company level? And of course, we all have investors, regulators, companies, everybody wants the markets to function as effectively as they can in a way that does allow for investor confidence in their decision making. But I must say, I don't entirely agree that the answer is more regulation of the service providers. I think it's important to say, there's some regulation can often be helpful, but I think you must be very, very careful with potential unintended consequences here. And so we would worry about any measures, particularly around proxy advice, that are set as regulations without really kind of getting to grips with how this stuff is used in practice, right? So I think there's often some misunderstanding around, you know, X investors voted, quote, in line with the proxy advisors. Well, of course, there's only two ways to vote. And so you might have voted for or against for a whole number of reasons. And in fact, you know, our general view across our membership as large institutional investors is that they would very rarely rely only on one proxy research provider. They almost all, and you know, this has been shown many times globally by lots of research, have proprietary voting policies. They'll have their own application. And so of course you use service providers to help cope with volume and scale, but it's absolutely important to remember it is only one input. And so I think sometimes the investor worry is that this call for additional regulation sort of comes from some parties seeking to effectively influence how the vote gets cast, right? And so this any kind of regulation, we quite like the current transparency-based best practice principles group model around proxy advice. That seems to work very well. It allows for that client relationship. But everything can always continue to evolve. And actually, I think there's a lot happening in how the industry works, how you know, with the advent of technology, we're seeing a lot of change. And so I think we must, you know, be a little mindful that the goal here should not be to try to seek to introduce regulation. That really is about trying to get the proxy advisors to change their recommendations, because you remember that the investors are eventually going to make the decision. And then, of course, on the ESG data side, and I must say, I do think over time we need to perhaps think of a new name for these data providers. And as the accounting standards roll out around the ISSB standards in particular, we hope that that'll be a fundamental shift in the data landscape also, because they are absolutely increasingly important. And I think one thing that's interesting is, because of the fragmented reporting environment, right, there is, as you rightly noted in that presentation, quite a bit of estimate. And so I do think transparency is always a great place to start. So more transparency around methodologies, definitions, assumptions, scoring approaches can absolutely be helpful. But again, I'd caution that, of course, most large institutional investors will also have proprietary ways that they rate and score all these types of factors in their models. So again, we shouldn't get too caught up in the sort of public benchmark number, which of course is used by some participants, but I think, you know, we don't want to mislead people into thinking that these somehow outsource investment decisions. That's not how this is used in practice. And so they absolutely feed into construction, particularly the data, into analysis, into stewardship thinking. But we've got to kind of need to think in a balanced way here, because I do think there's a risk in seeking to do a good thing that we might inadvertently create barriers to entry. We might regulate something at the wrong time, right? A huge amount is changing in technology and how all this works. And we just want to make sure that, I think, having a diversity of analytical approaches and a diversity of research available to investors to choose who their own service providers are is a right of them as a shareholder, right? And so I think we just should be a bit mindful of that. Now, of course, that's not to say there aren't public policy things that we agree with completely need to be done, right? And so all this stuff around market data integrity, is the reporting landscape good? Are the corporate governance disclosure requirements good? Is the timing of that disclosure right? Because if you get the timing right, then you have less estimates, right? And so I think a lot of things that we think can be done here. But I really would just say we need to start at the full understanding of not just what exists in the market, but how is it actually used in practice? And I think that will help to lead us to the right answers.
Thank you. Very important points and also very, important considerations. I have to say the report is also in line with the G20 OECD principles is so recommending, I would say it's not an obligation by result, not necessarily, let's say, public regulation, but also could be recommendation, self-regulation. And you mentioned the transparency-based, the proxy advisory, you know, also the model that also we have seen, which is quite important. And obviously, because the trade-off of some, let's say, the regulation of whatever oligopolies or monopolies can be in some cases to raise the barrier to entry, and also I think you indirectly address. It's important, transparency, the role of transparency. Transparency, light is the best of disinfectants, as Luis Brandas was saying, and also important. This is a reputation industry, so as you say, I would say across the three dimensions, this is not an outsourcing of investment decisions to them, obviously. So it's
that's right. That's right. And I think, you know, the kind of part of the worry, I think, for investors when you hear about, well, let's have regulation of proxy advisors, is that it feels like it's coming from kind of a view that the proxy advisors either tell us how to vote, which just isn't true. That's not how that contractual arrangement works, right? They make recommendations typically based on an institutional investor's own voting policy. Or second of all, that the regulations will somehow increase the number of votes with management, right? And so I think we just want to be a bit mindful that, like, this is why the best practice principles group is great, right? And should be a good model, right? Because it speaks to all of the things in your report, right? Transparency of conflicts, transparency of methodology. And it may not be the model forever, but for now, I think it works pretty well. And again, so much happening in how this is actually done in practice. It's an exciting time to see where the market goes around all these types of service provision.
Thanks a lot. Also, we have interacted with the chair of the group, also at the OECD, so it's very good. Now let's go to the Indian experience. So Jan Gupta. So now India proxy advisory markets appears distinctive in several respects. So domestic firms have taken on a role that in many other markets is often occupied by the international providers. And so proxy advisors typically do not offer actually consulting services to issuers. So what lessons can other jurisdiction and proxy advisory firms draw from India experience? Gupta. We don't see you.
Hello. Yeah.
Hello? Yes.
Okay.
Okay. Yeah. Now we see you. Please.
We have asked a very important question, that how we are different from the world. We got to get into the background, how we started in India. Till 2008, none of us had heard about proxy advisory in India. It was no business there. The 2008 crisis brought the governance to the core, the 2008 financial crisis. Then what happened in India at that time? Mutual funds were growing, and there were certain corporate frauds which brought the core of governance in the market. Regulator SEBI started saying that the mutual fund should vote on the resolution that is brought. And then later what happened? The new laws came. Earlier in India, there was only physical voting. The AGMs were the physicals. But then the e-voting started. So all this gave a fillip to the governance process in India. Next, what happens in a market? Early movers always set the tone. And when we started in India, there were no regulation, nothing about the proxy advisor. When we started, we studied all over the world what was happening. And we found that there was attempt in various jurisdictions to regulate proxy advisors, whereas proxy advisors were resisting regulation. And the companies were saying that the proxy advisors are very powerful. So we studied each and everything. And when we started, we said for a proxy advisor to be very successful and reputant, the independence, conflict, transparency are the must. And next is the quality. So we started all this. Then later what happened over a period of time, when the proxy advisory industry was established, the business was very low. So why foreign company could not come to India was two couple of reasons. One is the market size itself was very low. The second, the tone of the government that the proxy advisories had established in India was a bit different from the others, because in other jurisdictions, the same proxy advisors were registering regulation, and they would not want to register in India, because then there will be some sort of a difference of opinion that one place you are registered, other you are not registered. And third is this, that Indian market is divided in the sense that when you look at the ownership structure, the 50% of the company equity is held by the promoter or individuals, their physical person. Then rest 22 or 23% is held by the institutional investor, of which it is equally divided between domestic investors and foreign investors. So what happens that all the domestic investors are using the domestic services, whereas the foreign investors are using all the services of ISS, glass solution, etc. So that way the market was divided. The next came when we started. Later on, there were certain murmurs in the market that proxy advisors are very rigid, they are not doing something. So the SEBI came up and they started regulating us. So they started regulating, and over a period of time, the regulations were set and the problems were there in the market. Then SEBI set up another committee to look into the proxy advisors rule, and the proxy advisor, the company that came up with a new code of conduct. And if you see that in India, whatever you have said in your presentation, so whatever are the shortcomings there elsewhere, we have in India handled all those shortcomings. And whatever is still lacking, it is lacking because of certain reasons which we can explain during the question answer session. Then what happened? There is another issue is this, that proxy advisors are becoming very important. They are all powerful. I say it is not a fact in India at least, because in India the mutual funds and all other investors are required by law to vote, necessarily vote, and explain their rationale for voting either for the proposal or against the proposal. Proxy advisors are required to give their recommendation along with the rationale. So the mutual fund, whenever a client compares, they compare our rationale, they feel their rationale, they have a policy. And most of the mutual funds, they have a committee where they are voting against the recommendation of proxy advisor. It goes up to their hierarchy. So that way, if you look at the voting pattern, not all the companies are voting, not all the investors are voting according to what is the recommendation. Hardly 10 to 20% of the votes are the same way that proxy advisor is recommended. We in India, and at least my company, we do not say that we will allow auto vote. So if somebody approaches us and they say vote for us, we will never do that. The most important thing that we have in India, none of us are doing one-to-one advisory. And there is one point in the presentation, you said that proxy advisor should be sharing the draft report with the client, with the companies. We have been opposing this, and we started right from beginning that we will not share the draft report. We will share the final report simultaneously with the investors and the company. This has a couple of advantages. One is this, that if I send the draft report, then I'm not bothered about quality. It is the issuer which will correct my quality. So we will never improve. So that was one. Second thing is this, it is the investors who are paying us money. It is not the company. So investors have first right to see our report. So that if we change our recommendation, investors have very good idea that what was the rationale. If I share the draft report and change the recommendation, investor will never have an idea of what happened behind the thing. That is the thing there. The next comes the ERP, the ESG rating provider. I think most of the things that the ESG rating provider, the conflict issue has been addressed. One issue that I found in the report was that why India has two different models, subscriber pay and issuer pay. The reason is very simple. If I am paid by my subscriber for those companies, those reports, I should not charge the same from the issuer. And if I charge from the issuer, then I develop a contract, privity of contract between the issuer and me. So we wanted to avoid all possible conflict, and I can explain what situation will be different because in India, subscriber base only uses the public data. Whereas if you go to issuer, the further data which is not in the public domain may come. So they may change the ratings. So these are the things at this thing, and I will stop here and then we can do the question answer.
Thank you very much. Very interesting perspective on some of the most also important aspects dealt in the report. But first of all, it's interesting because also the structure of the industry, I would say, is different from other markets. And okay, we start in a sense from scratch. And I mean, you touch many important topics, and I guess that some of them will be also touched upon in the question. But obviously, for example, the sharing of the draft report with the company. I mean, you have made a strong point. I mean, it's not the company paying this, but the investors, and so in a sense, not creating asymmetries. Obviously, there is a strong also debate on these. The idea is also to check if there are, let's say, factual things. But I think we will go back on this. Neil, the report now to you, MSCI. I mean, the report highlights concerns about market concentration in areas, in particular, such as ESG ratings and indices. So how can policymakers, you think, I mean, being of that side, promote, I mean, greater transparency and quality, but while preserving the benefits of business models that rely on technology and scale? And I would say, because there is the issue of providing many services, so of economies of scale and also economies of scope. Neil, back to you. Thank you.
Thank you, Carmine, and hopefully you can hear me loud and clear before I start. Very good. First of all, I do apologize about the rather dramatic lighting, but it's part of the troubles that we have, as you know, Carmine, of traveling and hotels not designed for effective webinars. So I apologize about that, but hopefully it makes more dramatic what I'm going to say and more interesting what I'm going to say. But thank you very much, Carmine, and certainly thank you to Caio and the team for a really substantial piece of work. I think, you know, from my perspective, the OECD's engagement on these issues is generally valuable. And certainly at MSCI, we appreciate the opportunity to contribute to the dialogue. MSCI has been an active participant across both ESG rating sector and index provider sectors for decades. And I do want to use this opportunity just to highlight something that I feel the report doesn't fully capture, which is really the significant value that providers like MSCI bring to investors, the markets, and the broader economy. To answer your question directly in terms of market concentration, you know, I read the report and based on your initial comments as well, I found that the report finds that ESG ratings in index sectors are characterized by the participation of a small number of firms. I can raise doubts about that and questions, but perhaps not for this intervention. But I do want to put it all into context. And Carmine, you raised some of it in terms of your opening remarks, which I do appreciate, because really the depth of analytical capability that MSCI and others have built represents really decades of investment in data infrastructure, in methodology, in technology, which is all operating at a global scale across thousands of issuers and markets. And that scale is not incidental to the value we provide. It's really what makes it possible to actually deliver consistent, comparable analytical frameworks that investors around the world can rely on. And these efficiencies of scale ultimately benefit end users through greater coverage, deeper research capability, and importantly, ongoing innovation. And it's important that any economic analysis of the market includes these dimensions of value. So in other words, we're not just looking at provider count, how many numbers of providers are there in the market and what do they do, but we're actually looking at the quality, the breadth and accessibility of the analytical services that global providers make available to investors of all sizes. I wanted to just split my remarks a little bit in terms of response between ESG ratings and index providers. And maybe we start with ESG ratings and data. I was very pleased to read that the report, and I fully agree, emphasizes transparency over methodological convergence. That distinction matters enormously. And again, that's something we can fully support. MSCI has always been transparent about our methodology. We focus on financially material, relevant ESG risks relative to industry peers. And that's because we believe investors are really best served when they understand what they are buying and they can make an informed choice. Others, from a methodological perspective, take different approaches, reflecting different investor priorities. And that diversity is a feature. It's not a bug, it's not a flaw in the system. It means that investors can access a range of analytical lenses and really select the one that is most relevant to their strategy. And if we look at the analytical ESG ecosystem that has developed around the sector, it really reflects, in my perspective, a genuine innovation in response to specific and again, genuine investor demand. So it's driven by investor demand, not by service provider push. Experience with the implementation of these policies does really matter here, though, because in some jurisdictions, requirements around methodology and local presence has contributed to international providers exiting the markets. And to me, that's bad for all concerned, and it's not a place where we want to be. Most importantly, it's bad for the domestic market because the investors lose the opportunity for accessing a range of analytical perspectives. And I raise this not to be critical in any way, but really because I think these types of outcomes are learning outcomes and absolutely deserve as much policy attention that in the policy analysis as the concerns that originally motivated the frameworks in the first place. Now, in introductory remarks, again, I think there was a reference regarding the perceived regulatory gap between ESG ratings and the regulatory frameworks not covering the raw data underlying them. I certainly agree with Jen that really the policy and the stronger priority here is to continue improving the quality and coverage of issuer disclosure. That remains the most significant constraint on analytical quality. The universe of what constitutes ESG data is so exceptionally broad. I mean, it's from emissions estimates to governance policies to satellite-derived metrics, most of which are not actually even developed for financial sector consumption. And a substantial part of the value that MSCI brings and other providers in the sector bring is really is in that capacity to estimate, to model, and to assess information that issuers themselves don't already disclose. And this is not light work. It's exceptionally skilled analytical work. It requires significant ongoing investment, and it fills a genuine gap in the information that's available to investors. To me, the right policy response to that gap is to strengthen the issuer disclosure framework and to recognize actually the value that the estimation and the analytical capability that markets have developed to try and fill that gap in the interim. I do also, just staying with ESG data, I do want to also highlight the fact that we need to look at the broader financial data context to help shape where we currently find ourselves. And it's important and instructive to note, I think, that many highly consequential analytical inputs used across the financial markets today, things like proprietary prepayment models, recovery rate assumptions in credit markets, the volatility surfaces used to price global options markets, operate without equivalent regulatory frameworks. And so the bar for demonstrating a clear need for regulatory intervention really has to be consistently applied. And the question asked, why do we need additional regulation in the ESG data space when these other critical inputs don't have it? And how does that work when we actually put that together to ensure that there's consistency of approach going forward? If we turn to index providers, very briefly, I think we all know that indexes, to me, are foundational to the modern capital markets. Index providers and indexes provide investors with low cost, systematic exposure to markets and asset classes. They support the development of both passive and active investment strategies. They serve as performance benchmarks that underpin accountability across asset management. And the index industry itself has delivered significant value to investors through the expansion of accessible, well-structured investment vehicles. The regulatory trajectory in most developed jurisdictions, including in the EU, has moved towards a narrower scope of regulation over time. And I think this is a good example because it reflects a regulatory maturity that is built on evidence of regulation of the sector rather than theoretical assumptions. And so I think there is a recognition within at least policymakers who have had years of experience that the original frameworks were broader than the identified risks warranted, and the recalibration of proportionality as far as how index providers are regulated is absolutely going in the right direction. I think from the OECD's report, in terms of proposing or looking at new policy interventions, I think it would benefit from looking at the experience that we've seen in these markets that have had regulation of index providers for some time, and to look at those lessons learned rather than suggesting perhaps new policy prescriptions and regulatory requirements in this space. Maybe to conclude, in terms of policy, I think three principles for me stand out, none of which are groundbreaking, and I'm sure all of which we've heard many times before. Firstly, and to repeat my comments earlier, we strongly support the focus of the regulatory requirements on conduct rather than analytical conduct, or analytical content, sorry. Transparency of methodologies, effective management of conflicts of interest, all the terms that were thrown around right at the beginning of this call are absolutely what we agree with. They're appropriate and they're valuable areas for regulatory standards. MSCI absolutely supports these principles, and we implement them in practice. They actually are being implemented, and we're overseen to make sure that they are. What we would, of course, caution against any policy design is that in practice, policy and regulation shouldn't involve itself in the substance of the ratings or the composition of indexes or the selection of indexes. These are absolutely judgments that belong in the market and for the market to make themselves. Secondly, recognizing that these markets are, of course, global markets, and that's important for any sort of policy thinking and regulatory design. Fragmented national frameworks, as we all know, adds compliance cost and really doesn't produce any better analytical outcomes for investors. And I think the work that's done through IOSCO to develop common principles for best standards has been and continues to be invaluable. The last thing we want is competition between policymakers and regulators as to who can find the best framework when there are already established vehicles to achieve that goal. And finally, third and finally, I suppose the peer reviews like this one are extremely useful and are probably most powerful when they assess the full range of evidence. And that includes evidence about where more prescriptive frameworks have produced outcomes perhaps such as reduced market participation or diminished investor choice, that warrant the same rigorous attention as the concerns that originally motivated the regulatory action. So, Combinate, we absolutely we're very excited to be sort of part of the engagement for the report. We're very excited to have continued engagement with policymakers and stakeholders like the OECD. We absolutely believe that this type of dialogue produces better frameworks. And we thank the OECD for their work in this space, and absolutely we look forward to contributing to that process as it continues. Thank you.
No, thank you very much for your words, also for your the layout of your room, which makes your intervention quite important. Also the thrilling for the 3 points, final points. No, it's great. Now we got some questions. Now we have 10 minutes, basically 12 minutes. So, and I will address. Actually, I have 4 questions for each. I will address to each one of our panelists, including also Toshi, and then possibly replies in quick in 2 minutes. And in case there are, or even shorter, if there are other questions, you can submit. Use a Q&A feature of the webinar. There is the bottom bar. Click on the up panel and select Slido. But let's try to go fast. But first, maybe Toshi, because. Given that we are talking about these trade-offs in terms of regulation and maybe self-regulation, the risk and opportunities, maybe very briefly how Japan, approaches the regulation of proxy advisors, ESG rating and data provider, and if there are lessons. Second, actually, J.N. Gupta, you are coming India, great experience. How you believe technology and AI may change the role of capital market service providers. Third, maybe to Gen Z, some jurisdictions, I'm reading obviously live, are considering regulating proxy advisors. Some say the objective would be to disincentivize proxy advisors to disagree from management. So what's your view on the difference between regulation that supports investors and one that may harm their capacity to discipline management? And maybe fourth, to you, Neil, in the cases where firms provide services to issuers that they can also assess what role maybe policymakers play in providing guidance for enhanced transparency of revenues and effective internal controls, given also your view from outside. Maybe let's start, Toshi, briefly on the Japanese.
On Japan framework? Okay.
Yes, framework. Okay.
Okay,
Perfect.
thank you very much. So, let me try to be brief. So Japan's approach to these, service providers differ across the three categories. For proxy providers, we address the proxy advisors through Japan's stewardship codes. And for ESG and evaluation and ESG rating and data providers are covered by the FSA's code of conduct, voluntary code of conduct for those providers, with a focus on ensuring transparency, ensuring communications with companies and issuer, and the management of conflict of interest. So broadly in line with the kind of discussion we have done thus far. For index providers, Japan has a more formal legal framework in the sense that that is subject to the regulation under the Financial Instrument and Exchange Act, FIA. But this framework is limited in scope, maybe according to the systemic importance, because the financial indices specified, the two specified financial indices, that is namely TIBOR and the TOF. So this is limited in scope. So they are subject to requirements on methodology disclosure, consultation on changes, periodic review, and conflicts of interest management. Overall, Japan's experience highlights the value of combining high-level principles with market engagement, which allows frameworks to evolve over time while supporting transparency, accountability, and market confidence, as discussed so far. Thanks.
Thank you. Thank you. Let's move to India. So remain their side in Asia. So Jen Gupta, how you believe technology and the AI may change the role of capital market service providers? Short answer.
See, this is a very challenging issue at present, which is baffling everybody. But we are very clear as far as our company is concerned. We believe in bespoke research. The AI can at the most tell me what has happened in the past. The data that is already there in the public domain, they can search and give it to me. But data always have a context. You cannot analyze the data without a context in that. And that is where our specialization, right? So we will never use AI for analyzing what we are recommending. We may use AI only for the mapping of the data, but even that data, we will continue to verify and see the context of the data. Therefore, that is why the market has to understand that what they are looking, are they looking for a report just like a report, or are they looking for a report which is a quality? So AI can bring the uniformity and everything, ease of doing things, but AI will not be able to bring the individual centric research and quality. So that is how I feel the challenges are there, but it is at the end, it is the quality which will win, and we will continue using our bespoke research on that.
Thank you. Thank you very much, Jen. ICGN point of view. I mean, obviously, again, the topic of regulation, I mean, we mentioned at the beginning. So, but one, is there the risk that maybe regulating proxy advisor, this may disincentivize, in a sense, proxy advisor to disagree with management? Obviously, disagree with management should not be an end in itself. I mean, there should be only if there is really an issue. But how you see this? Because I mean, then you need proxy advisor, and again, institutional investors, they use them to make their then informed decision. What is your view about this and this unintended risk that may be there?
Well, I think it's an interesting way that the question is phrased, which I almost think says quite a bit about this debate all up, right? And it's interesting, and it's kind of similar to what Neil was saying, that any regulation around service providers must absolutely not be done from a place of then hoping that those regulations will change the analytics, right? So any regulation around the data provider shouldn't be seeking to change what their estimates are necessarily, just to say that you've got to do things in a way that promote quality. I think that's probably something everyone can agree that quality is important. Similarly, I think it's a fair point that's raised here that it does often feel as though the momentum to regulate proxy research providers, and I think that's probably helpful. Advisors is sometimes a bit of a tricky word here. Does come from people whose, it would appear their goal is that they should just recommend with management on everything. And if they did recommend with management on everything, no one would ask them for them to be regulated, right? That's how it feels. And so that's definitely, I think, a concern. And is absolutely, if you're listening to this as a policymaker, I think the thing to think is, why are you seeking to regulate, right? And is that needed, or is this actually a service provider relationship between two professional organizations and they can work it out? Now, I think there's a lot of unintended consequence risk here. Now, of course, there are opportunities though in increased transparency and in increased quality. So, there are other markets in the world where we know that there are people who seek to regulate proxy advisors because they don't think they recommend against management enough. But it does often come from a place of, I don't like the recommendations, and therefore I think there needs to be regulation. And I don't think that's helpful. I think what we would be a better way to think is, what is the sort of minimum safeguard of quality that is needed? And do we need a regulation, or in fact, does the self-regulatory model work quite well? And all sorts of different service providers, the answers will be different. But I think it's an interesting and important question.
Thanks, Neil. We're also getting other questions, but to you, because I mean, this is also when there are different kind of services that are provided, by firms. So what role then, again, without risking to throw, the baby with the dirty water, can policymakers play in providing some guidance for enhanced transparency of revenues and effective internal controls? Again, and this also because with all the economies, and you mentioned very well, economies of scale and scope, not only you mentioned that maybe there is more competition than what is normally seen, but also obviously this is a reputation industry based on information and skills there, and there is a lot of investment and cost. But please.
Yeah, no, I think it's a valid question, and I think that it's always an issue that the industry sort of grapples with more broadly, and I think from an MSCI perspective, we're primarily subscriber based, so we don't have the sort of direct relationship with the issuers that maybe some others have. But I do think where we need to start from any policy question around this is really, we can't be in a place where we have to say we're going to eliminate conflicts of interest. There will always be conflicts of interest, regardless of whatever business model you have. And so if you start from a policy objective saying we need to eliminate conflicts, and the way we eliminate those conflicts is forcing companies into specific separate legal entities with separate regulation, that is a disaster for sort of global finance. It's not going to work that way. I think the most effective, and again, I come back to the work that IOSCO does in terms of the codes that it publishes, those codes tend to be long-lasting. They tend to be very effective and very, instructive in terms of setting out regulatory expectations for transparency and for internal controls. And us as providers take those very seriously. They're very important to us when we engage with our clients to show that what we're implementing meets those standards. And so we've got to be careful about things about transparency, about revenues, etc. Because as soon as you start talking about transparency of revenues, then you're actually being transparent about how much you might be getting paid for a service, and those analysts then see how much you're getting paid for the service, and you actually introduce new conflicts. What you want to be doing is making sure that the transparency that you have out in the market is saying, hey, I rate this particular security. I also receive revenue from this particular issue for other products and services, and stop there. So that at least the user of that product and service is aware that there is a potential for conflict. And then they start asking questions about how you mitigate that conflict, which then goes down into your internal control systems, which obviously is also a requirement for, transparency in terms of explaining to your users how you meet those conflicts.
Well, thanks, Anil. I think that, okay, we are at 11, so probably we have to close, even if we have other questions. I think I mean, overall, I mean, thank you for all of you for being here. I mean, this is a very important topic. I'm happy also that we have been dealing with these in the corporate governance principles. This has been okay. Also, all of us had different experience and, in the industry. Transparency is an important issue, Neil, you were saying, and on both sides. So what is important, I think what is that been the evolution is that also transparency is from the issuers to the market, and also in a sense from the market and the service providers to investors, because then in the end, this is what is important. It's important we are now in the process. This was also another question in many countries, big discussion on also maybe too much regulation and then and have a lot of red tape. So simplification, which doesn't mean deregulation, but means proportional, approach, because in the end, it's important that we still have on the market many companies and then the possibility for many investors, citizens, directly or indirectly through institutional investors, to invest in those companies. So it's important not to have maybe the perfect regulation with an empty market, but to have proportional approach, because this is in the end important for growth, creating jobs and growth. And so in the end, just to conclude, so having then better policies for better lives, and we hope with this report again to have shed even more transparency. I think it's important that all of us you have contributed. This is the work of the OECD, the corporate governance principles, the corporate governance committee, and Toshi is also deputy chair. And so again, we will follow up also with these. If there are other questions, things, let us know. But thanks again. Also, I see there were many participants and attendees. Thanks to all of you, and have a nice, rest end of the day for some of you in Asia, and then day here in Europe or even in the States. Thank you very much to all. Bye-bye.
Thank you. Thank you.